I want to bring in Michael Antonelli. He's a market strategist at Baird, joining us on Skype. Mike, missed you in Chicago, but glad you could join us this morning. So you've got stocks about to have another solid pop at the open. This week has been stringing together some gains. What are you taking away from it? Is there a clear cause, catalyst? Is it believable?
Yeah, so when I think about August, you guys mentioned it earlier. If you took the entire month as a whole, we're really down less than 1% if you use total return. So a lot of sound and fury signifying nothing. I think the trade war and the tariff stuff has been leading us around like we're on a leash. But economic data has been okay. Look at the Citigroup Economic Surprise Index. It's had a 2-month run higher. Look at Target and Walmart, and we can talk about that a little bit later. The consumer's still doing fine. We actually saw a little bit of it this morning in the data. So, this notion of muddle through, I really think it's the best way to describe kind of the post-GFC world, and it continues to be the same.
The muddling through, I think, is an important reminder because a lot of people are looking for this sort of a big systemic event to occur, and there might be pockets of froth still in the market. There might be pockets of froth, across asset classes, big runs in bonds, big runs in gold, and big runs in valuations the last 7 months. But does it necessarily have to end, in a brutal fashion?
No, I don't. And you always talk about January 2018, and I think it's just a great thing to come back to because January 2018 was this kind of soaring top, and then we kind of spent a little while moving towards a grindy market, and that's what we're in right now. So, no, it doesn't have to end really poorly. We don't have to end with another 2007, 2008. Every market ends in a different way, and just because we have these bad memories of a housing and consumer-led crash doesn't mean this one has to end that way. We could have a shallow CapEx business recession. It just doesn't have to be like the one we just saw.
Yeah. Mike, I'm looking at the valuations here that obviously we see peaked in that Jan 18 high at around 23 times. The valuations, lower with each subsequent high since. Right now, we're back up to 19.1 trailing according to Bloomberg. Here's the question though, is even if the market doesn't have to fall apart, does it have explosive upside when the trend has been paying less per share over the last 18 months? I mean, if we get back to 20 times, is that a short opportunity?
No, certainly it would depend on how earnings go from here. And if you want to talk about earnings, we can do that. But yeah, I don't think it's a short opportunity. I think if we get through this little dark period like 2015, 2016, you could get a little valuation expansion and it would be fine. Given where bond yields are, maybe a little valuation expansion makes sense. But it really depends on what earnings do. And earnings, like the economy, are muddling through. They're doing the same thing the economy's doing. Top line earnings are growing basically what nominal GDP is growing, 4 to 5%. So EPS is growing about 4%. But what really matters is margins, and we need to talk about that because if there was one thing you could let me know about next quarter's earnings, I would want to know what the margins were.
Well, I like this because my question on earnings is what's more important, the fact that we leapfrogged a negative number and beat. I mean, we usually do beat, but I think it's worth stating that this was a solid beat this quarter, or is it the fact that guidance going forward keeps dropping? We're now on the expectations that are still being revised lower since the start of the year, and it's a bottomless pit. When's it going to turn around?
Yeah. I mean, when we started the year, they were looking for about 10%. Analysts were looking for about 10% earnings growth. Now they're looking for 2%. Year over year. And if you look at 2020, it was supposed to be 11, and that's going to have to be cut in half or maybe more. So I just think we need earnings to muddle through. We need earnings to be fine. But in order for earnings to muddle through, margins have to be maintained. And you guys talked about the dollar. At the end of 2016, the dollar weakened, and that helped us get out of that earnings recession that we saw in 2015, 2016. Right now, the dollar's at its high, and you guys are talking about it breaking out. That would be a significant headwind to margins and to earnings. So as much as we think about the dollar here, we really need to think about what will that do to earnings expectations. You're right, they're being ratcheted lower. Maybe some dollar weakness would help. But margins really are what matter. Margins have to be maintained, or else you could possibly see earnings stay negative, year over year. I
think this is a good point because the dollar to me is tricky, Mike, because the margin point that you bring up is just math basically. If you're an exporter, right? Dollar goes higher, that's not going to help you at a time where you might also be dealing with overall slowness. However, again, last 18 months, last really, 2 years almost, the stock market keeps coming back, and the dollar's basically only gone in one direction. So how do we sort of reconcile that with the traditional thinking of high dollar bad for big companies?
Yeah, I think it's probably mainly the Fed. It's probably a lot to do with expectations around the Fed. The market really does get a goose from the Fed, and earnings and central banks all over the world are easing. So it's probably due to that expectation that the Fed is behind the market, has the market's back. But, the dollar is just math. You're right. It's just math. So we really have to watch that and say, what does that mean for earnings and margins? And I really think that's a concern for me going forward.
So this becomes, I think, also important to bring up the Fed and what happened this week, because our data here continues to be very solid. Consumer continues to be solid. Market expects that cut, but the chance of a double cut now has basically gone down to zero. And it was as high as like 20% the week after we sold off from the high. So the double cut's been taken out of the market. But Mike, how important is it still to figure out and think about the chances of solid data interrupting the cut cycle that so many expect? Because to me, if you're looking at $182 on earnings next year, which is what Bloomberg now estimates after the lower revisions, if you do an average multiple of 17, that gets you to 30.94. That's not bad, but it's not exactly a huge new high. But I imagine that multiple is going to depend on largely what the Fed does too.
Yeah, that's right. That valuation expansion will definitely depend on Fed action, and I think that the notion that we're going to get 50 basis points in September, market predictions get really good near the event. Fed funds futures markets get really good at predicting what the Fed's going to do really, really close to the event. So the 20%, obviously, it was the market being wishful about some sort of massive stimulus or some sort of massive cut. I think 25 basis points makes a lot of sense. They're probably going to do another 25 sometime before year end. But the economic data and the consumer data is still strong. Look at the earnings of Target and Walmart. Look at some of these insights. Look at new home sales. Look at leading indicators. Some of these insights into the economy are the fact that the Fed doesn't need to go 50 basis points. I know the market wants it, and I know the market gets panicky about that kind of stuff. But I think 25 basis points is going to work for the Fed in the upcoming meeting to try to ease a little bit of financial conditions. The market certainly wants it. The yield curve certainly wants it. But valuation expansion is probably going to be elusive for us for a little while.
I think this is an important point, because if it's a little bit more elusive, if the Fed plays some hardball, doesn't mean they won't cut, but if they don't give, the beautiful language that markets want, then you basically either have to replace the cuts with earnings revisions to the upside. Something's got to give there, though, right? I mean, if there's not a change on either one of these, Mike, do you see us sort of lasting at elevated valuations for a long time?
Yeah, I think the best you could hope for that point is that earnings just can muddle through, that 18, 19 times is the best we're going to have for a little while. We grind sideways for a bit, which is okay. I mean, we don't necessarily need to race back to the highs and get, valuations to rapidly expand. Even if we had a consolidation period for a year or 2 years of trying to get through this kind of difficult time with trade rhetoric and uncertainty around global growth, that would be okay. I'm not one of these people that thinks we need to rush back to some sort of higher level evaluations. Yeah.
Mike, before we let you go here, this week also marked by what apparently we're led to believe is positive trade developments. Nobody really knows at this point what's going on, who's calling who, but it seemed to be perceived as positive. To me, there still seems to be gas in the tank if there is some deal done. I mean, is this going to be just a massive rip, Mike, if we do get some resolution? Do you want to be positioned based on that, or is that just too much of a gamble?
It's probably too much of a gamble. I'm not a big fan of headline markets. Certainly, we would tell our clients, look, it's tough to play at headline markets. Stick to your plan and try to ignore the noise in the near term. A trade deal would certainly help the market in the short term. I think it would, but it's not like the markets are going to embrace that worldwide and all of a sudden global growth is off to the races. I think you'd probably get a period of algo reaction. You'd get a period of spike in the market, but then we're going to go back to this notion of, wow, the globe is still kind of slowing, negative rates all over the place. We still have to deal with that. But I certainly think that we need less punches to the face from the trade war stuff.
Yeah. All right. There we go. Michael Antonelli, really good wrap up here for the week. Appreciate it. Good to catch up.